Investors appear to be in upbeat mood, anticipating rate cuts this week in both Canada and the United States. Let's bring in John Zechner, chairman and founder of Zechner Associates. John, let's deal with the thanks for joining us. Let's deal with the central banks. Do you think we will get cuts on Wednesday?
Hey, good morning, Andy. Absolutely. I think we get a quarter point both in the Bank of Canada as well as the U.S. And I think the Bank of England goes on Thursday as well. But I mean, you've got an inflation number coming in Canada tomorrow. But I don't think, unless that's dramatically, to the upside, that's not going to change anything. I think that second quarter negative print on GDP in Canada really cemented or moved them towards the idea of cutting rates a little bit further. On top of that, I think the fact that the U.S. is now cutting gives them a little bit more leeway, because the fact that Canada cut while the U.S. wasn't, and yet the Canadian dollar held firm in the range of the U.S. probably gives them a little confidence there. The U.S. side, despite the pressure from the president, I think the Fed only goes a quarter point this week. I think there's still a more gradualist approach. I think they also go a quarter in October and December. But I just think with inflation, core inflation is still running around 3%, and the stimulative programs from the big budget bill and all of that's still in place. I think they are still worried about the inflationary impact, although clearly, I mean, the recent employment numbers in the U.S., the comments of the Beige Book 2 weeks ago, all of that is just showing a very quick slowdown in the U.S. And we've expected that for a period of time. I think that's coming to fruition now. And I just think that employment is a big factor. I mean, consumer spending has been strong. I don't think that's going to change necessarily the overall economic view. I still think it's to the downside, because in the end, moving a quarter point isn't going to change people's decision on whether to borrow. I mean, they feel comfortable borrowing and spending because they have a job. There's fewer jobs available, and they're adding fewer. So.
And you have a note of skepticism here on corporate earnings south of the border. You say they look good, but a lot of that driven by massive spending on AI.
Well, absolutely. I mean, when you look at it, it was a good beat in the second quarter. It's about a 12% annualized rate, but that really all had to do with the 20% plus for the technology sector. I mean, what we've clearly seen is this, AI spending boom on data centers and expansion, GPUs and processing, and moving from large language learning models into the inference stage is still feeding the spending in that sector. Outside of that sector, Andy, you're probably looking at about 4 to 5% earnings growth. Companies are reticent right now. I mean, they're absorbing the tariff impacts that will continue. And I think, with the tariff and trade uncertainty, companies generally are not making big capital expenditures. They're not adding to the employment rules. I think that all points to the downside for earnings outside of the tech sector, which is why we still, maintained a bit of a weight there and really lightened up more on some of the cyclical sectors.
What about bonds, John? There are these worries over government debt around the world. Are you avoiding bonds with long time to maturity?
Well, not really. We've really changed, actually. It's funny you mentioned that, Andy. In the past week, we really changed my bond strategy a little bit. I mean, we've been looking for a cut in rates. We've been looking for this economic weakness, and which really means, cuts across the curve. And we had a position in long bonds, which has not worked out great necessarily most of the year, but it has rallied in the past couple of weeks. We took some profits there, and that's well. I think what worries me a little bit, Andy, is historically, I think the next Fed chairman, could end up being Arthur Burns 2.0. And let me just give me a little bit of color there. William Martin was the head of the Fed from 1951, actually appointed by Harry Truman until 1970. In the 1960s, he really resisted pressure from Lyndon Johnson and then from Richard Nixon to cut interest rates, and because he was worried about the inflationary impacts of the Vietnam War. He resisted that. When he finally was replaced in 1970 by Arthur Burns, he really was malleable to the pressures of Richard Nixon to cut rates, and he did that very aggressively. And what that led to was that giant explosion in inflation in the 1970s. And in retrospect, Arthur Burns, regretted that historically a lot later, and he's renowned or remembered as being one of the worst Fed chairmen ever. And then Paul Volcker stepped in, and he had to raise Fed rates to basically 19% to quell the inflationary pressure. So, Stephanie, with that in perspective, I'm a little bit worried that we may be, we could potentially be doing this again. And, if they put someone who's very malleable to what the president wants, which is dramatically lower interest rates, short rates may drop. The long end could spike, quite honestly, because people will be worried about the inflationary impacts of the longer term. So we've moved out of sort of the longer end and sort of gone into the mid, the belly of the curve, the mids, some corporates and things like that. Just change that strategy. I still expect lower rates, particularly at the short end, but I'm getting a little more concerned. And we've had a nice rally at the long end in the past week, so we did a little shifting there.
You have been adding to positions in stocks that may do well as interest rates come down, partly because they pay big yields. Telus and Rogers among them?
Yeah, I think the worst of the telecom scares is over right now. I mean, they obviously suffered because of the slowdown in immigration, and that's all your new user at the telephone because he doesn't have a telephone. And then obviously Freedom Mobile is the fourth player, but downward pressure on prices for a period of time. That seems to be eroding now. They're getting more pricing discipline. These are great assets. Companies, like a Rogers Sports assets, what Telus is doing, and how even BCE's move sort of into the the long fiber part in the U.S. I think there's still growth here, and these stocks are trading at 6 times operating cash flow, 10 to 12 times earnings. They got great dividend yields, good long-term assets. So yeah, we've been adding to that as well as other interest-sensitive stocks, and we're continuing to hold a decent position in technology because I think why fight the trend at this point? The AI spending will continue. The spending in tech is in cloud is growing, and the only thing I would add is there's a new 800-pound gorilla in the room that got unveiled last week.
You have lightened up a bit on the Mag 7, John. Is there one of those big tech names that you think is particularly overpriced?
Well, that's sort of following up on my last point a little bit, Andy. I think Oracle numbers last week were a real eye-opener for a lot of people because Oracle has always been sort of a fourth player in cloud. They really had more of a corporate database usage. It wasn't really a consumer application. But what you really see is, that's a big contract from OpenAI, apparently, for the Chat GPT, $300 billion over a number of years is going to take, the software and the data set is spending on AI from Oracle from around 12 billion this year to you're expecting 144 billion by 2030. It's a 5-year growth rate of over 75% a year. So clearly, they are being a major player now in the AI spend. Now, that solidifies their fourth spot in that. Is it just their growth, or is that going to borrow a little from the growth in cloud of the three major players, Microsoft, Amazon, and Alphabet? Microsoft particularly a little bit more at risk from that one. So we have lightened up on the Mag 7 a little bit, took money out of NVIDIA, a little bit of Alphabet, Amazon, took Meta off the books, and we added more to the software players and some of the AI users who I think will benefit from the implementation, the inference stage of AI over a longer period of time. Oracle's a new name, bought Adobe on the earnings last week, and I think on a valuation basis, breaking my cardinal rule of never buy value in technology, but I don't think you can, the end of the Adobe Acrobat is there. I think they will, move over and sort of mitigate some of the impact of AI. And Shopify in Canada continues to, 25% plus revenue growth rate, and now they're hitting this nice phase of going through the break-even levels and generating positive cash flow. Could lead to an earnings acceleration. And, this thing is the second largest stock on the TSX. I can guarantee you most Canadian managers don't have this as their, second largest weight. So there could be a little, just like in the gold sector, a little chase into year end of buying to sort of to match up a little bit.
That's it. You're talking about Shopify and its big weighting, John.
Shopify, yeah. I'm talking about, yeah.
That's interesting, yeah. What do managers like to have a portfolio that doesn't differ too much from the index? I think there's always that pressure.
Yeah, there's always that pressure. I mean, I sort of go back to remember, when Nortel was 35% of the index back in the late 90s, and no one was going to carry 35% of one stock. I mean, it was against so many mandates, and you just couldn't do it. And look in the Mag 7 now in the U.S. of over 30% of the index. Most managers just don't typically do that weight. We have more diversified portfolios. We'd have to mitigate risk a little bit more, so you don't have necessarily those huge weights. So I think in Canada, it's couple of things. I really doubt there are very few institutional managers who have an index weight in gold, which is 12%. Some people like gold, some people never own it. That's a little bit of a risk of, I guess, underperforming. Same thing with Shopify. I just don't, because it's a high value stock and people have always backed away from it, ourselves included. But, the way they're delivering recently, and like I say, what I think they can do on earnings, and now they're sort of hitting this breakthrough level, they remind you of Amazon about 8 or 10 years ago. And I think they can grow, the price can grow from there.
John, thanks very much indeed.
Hey,
John
Andy.
Zechner.